Hello and welcome to the Business Standards Morning Show. I am Kanishka Gupta and let's have a look at the stories for the day.
रामू दो चाय दे यार।
अरे नहीं यार, एक चाय कॉफी।
We Indians disagree on everything, but we agree. SBI is the banker to every Indian.
SBI का home loan. I agree with you.
SBI is the banker to every Indian.
Today is the first day of the new financial year. And as it happens every year, a set of changes related to income tax are coming into effect. One of the highlights of the new regime is 30% tax on cryptocurrency gains. What are the other changes and how are they going to affect you? Let us find out in our next report.
As the new financial year brings new tax rules, taxpayers should bear in mind that the deadline for filing late income tax returns for the assessment year 2021-22 was March 31st. If an assessee missed this deadline, he or she will have to pay a penalty and interest and may even face imprisonment for violation. Further, not linking PAN with Aadhaar from today will carry a penalty. Rupees 500 will be charged if it is linked within 3 months from today and Rupees 1000 if done thereafter. Although the PAN will remain operative, linking it to Aadhaar will cost you money, and if left unlinked beyond March 31st, 2023, PAN will become inoperative. Perhaps the most important tax rule that's coming into effect today is the flat 30% tax on gains from the transfer of virtual digital assets, including cryptocurrencies and non-fungible tokens. A new provision allows individuals to file an updated return for errors or mistakes within 2 years from the end of the relevant assessment year on payment of a penalty. Both these provisions come with certain riders. The surcharge on long-term capital gains on all types of assets will be capped at 15% from today. This cap was previously applicable only on listed equity and mutual fund units. Neeraj Agarwala of advisory and financial services firm Nangia Anderson India tells us more.
I think the most critical would be the crypto tax. For any gains which are made on a cryptocurrency, there will be a flat tax rate of 30%. Only the cost of acquisition will be allowed as a deduction. No other deduction will be allowed. Even if you have 10,000 rupees as income, you will still have to pay taxes on it. The threshold limit, the slab rate will not be applicable. You cannot offset losses from one virtual digital asset with the gains of another virtual digital asset. So theoretically, if you make profit in Bitcoins and loss in Ethereum, you will have to pay tax on the profit and just forego or let go the losses. The other important change is there's something called a voluntary return. If for any reason I have made any mistake in my previous returns, I can voluntarily file an updated return. If I do that before it comes to the notice of the tax authorities, then I get immunity from any kind of prosecution or penalty. But of course, when I file the return, there is an additional tax that I need to pay depending on the delay. So if I file the voluntary return between 0 to 12 months, I have to pay 25% additional tax. And if it is between 12 to 24 months, then I have to pay 50% additional tax. Then a couple of other good relief. One is for capital gains. The surcharge on capital gains for listed securities was capped at 15%. Now, this cap is also applicable for all capital assets. So if I sell a flat and the flat was, let's say if I'm making a profit of 10 crores, then I would have had to pay my normal capital gains tax at 20% plus a surcharge of 37%. So now that surcharge is capped at 15%.
Moreover, the interest on an employee's excess contribution over Rs 2.5 lakh to the Provident Fund account will be taxed year after year. The additional interest deduction of up to Rs 1.5 lakh under Section 80 EEA on home loan taken for affordable housing project has been discontinued. Higher TDS and TCS rates will be applicable for those who have not filed their ITR for FY21, the late filing deadline for which ended yesterday. Personal finance expert Harsh Rungta explains further.
Fairly big change affecting almost every salaried employee, and this is the change that we've been used to, the Provident Fund interest being completely non-taxable. Now, if the employee's contribution is more than 2.5 lakhs, then the interest on the employee's contribution will be taxed. And for that purpose, Provident Fund account will be broken up into two. There will be one portion that will be the non-taxable portion, and then there will be a taxable portion. So another provision that I want to sort of draw some attention to is the discontinuation of the additional benefit that was available, 1.5 lakhs of interest payable on a loan taken to buy an affordable home as defined in that section 80 EEA. Now that will not be available unless the loan was sanctioned by till 31st March 2022. Done is earlier, for the higher TDS provisions to apply, you ought to have not filed returns for 2 years. And in both those years, the TDS and TCS should have been 50,000 rupees. Now, the provision is that if you have not filed it for 1 year, you will be labeled as a non-filer, and the higher TDS and TCS provisions will apply even though it's just 1 year.
The taxation regime for cryptocurrencies and NFTs is being rolled out gradually. While the gains will be taxed at 30% effective today, the provisions related to 1% TDS will come into effect from July 1st.
सब अच्छी दिख रही हैं यार, कौन सी खरीदूं?
ये तो वही बात हुई, 4000 शेयर्स लिस्टेड है, कौन सा लूं?
वो तो सबसे आसान है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा पर है 4000 स्टॉक्स की रिसर्च, टेक्निकल टूल्स और इन्वेस्टमेंट आइडियाज। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
The new tax regime, however, is unlikely to affect the prices of smartphones. Meanwhile, the sales of iPhone in India saw a sharp 34% jump in the last quarter of 2021. It will reflect in Apple's revenue numbers too. And buoyed by the good response in government's PLI scheme, Apple is ramping up its production in the country. The government's production-linked incentive or PLI scheme seems to have helped Apple. But is it good for other sectors too? And what are the challenges it is facing? Watch our next report to know more.
To boost manufacturing, generate employment, increase exports, and cut imports, the government had launched the Production-Linked Incentive or PLI scheme. At present, it covers 14 significant sectors and involves a total outlay of 3 trillion rupees. And the government initiative has started showing clear results. This week, Apple's vendors have made a commitment of a minimum incremental production of 25,000 crore rupees of mobile devices in FY23 beginning from 1st April. It is a threefold jump in the commitment of minimum incremental production over FY22. But how is the PLI scheme progressing in other sectors? And what are the challenges ahead? Things are not going according to plan in one sector at least. On 30th March, a Financial Daily reported that of the 14 eligible firms, only 2 or 3 were likely to meet their first-year targets under the PLI scheme for IT hardware for the financial year ending 31st March.
Apple has seen a strong growth momentum in India, driven by deepening iPhone production and made possible by a diversified supplier base. At Cybermedia Research, our insights point to iPhone exports growing 192% year on year in 2021, and most of these were to developed markets. As such, I remain optimistic about Apple's long-term opportunity in India, as well as India emerging as an export hub. Having said that, there are always potential variables at play. These include, for instance, managing the input and logistic costs and keeping them competitive, as well as potentially managing a workforce of nearly 40,000 plus workers.
According to the report, some of the companies concerned blamed the situation on inadequate SOPs under the scheme. Meanwhile, others blamed the ongoing chip shortages and global supply chain disruptions. While the current corpus for IT hardware PLI is 7,350 crore rupees spread over 4 years, members of the industry have told the Financial Daily that they want the corpus to be expanded to up to 20,000 crore rupees. According to the report, the industry believes that additional incentives are needed to make India more attractive than China and Vietnam. Issues regarding allocations have cropped up in the past too. In November last year, the Department of Pharmaceuticals had urged the government to provide additional funds of about 3,000 crore rupees under the PLI scheme for drugs. Citing a senior government official, Business Standard recently reported that a decision on the demand would be taken once the funds allocated to the pharmaceutical department are utilized. The Ministry of Electronics and Information Technology is in charge for the PLI scheme for large-scale electronics manufacturing, IT hardware, and IoT devices. Business Standard had earlier reported that the ministry had informed the authorities concerned that it would require more than 22,900 crore rupees for all the schemes that it is running. However, the budget available with the ministry is just 2,923 crore rupees. The additional amount would be used to offer more incentives to companies and boost exports.
There are certain challenges, and I think like any other scheme, PLI scheme also has its sets of challenges. And if I were to name a few, I would say that I think the time given to the industry to really scale up in some of the schemes is less. I particularly refer to the IT hardware scheme. So as you know, that these companies did not get the full financial year to really work and to claim that benefit. So a lot of the companies could start their operations only towards the end of the financial year. And as we know, there have been certain shortages relating to the key materials like the chipsets and other components, which has compounded the problem. So our suggestion would be that the industry should be given a full financial year to really start the operations, to scale up and really to become globally competitive, which was the prime objective of the PLI scheme. Another issue which I would like to flag is particularly related to the IT hardware scheme. As we know that there is a large imports happening of the IT hardware, almost $6 billion worth of IT hardware is imported into the country. And I think there is a crying need for import substitution and to make India self-sufficient or truly Atmanirbhar as far as this product is concerned. So I think what was really required was a scheme to overcome all the disability factors which are there in India in terms of manufacturing. And as we know, this is one product which is already ITA1 bound, which means there is zero customs duty on these products. So I think what was required was a bigger corpus and a larger compensation to the manufacturers to overcome the disabilities. So our request would be to the government, and which has been through the industry associations, is one, to extend the tenure of the scheme, and two, to make it more viable for the industry to make India the next hub for manufacturing of these products.
Business Standard has recently reported that the government will undertake a two-stage review of the PLI scheme. During the review, the scheme's progress and implementation across various sectors will be discussed. Subsequently, the possibility of reallocation to government departments and ministries which need more funds will be assessed.
क्या हाल? मत पूछ यार, फिर से स्टॉक्स में फंस गया।
तो स्टॉक्स के साथ बॉन्ड्स, इंश्योरेंस, गोल्ड में बैलेंस कर।
इसमें बहुत तामझाम है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है 5 पैसा है ऑल इन वन अकाउंट। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Finance Minister Nirmala Sitharaman said that the PLI scheme has been a game changer in drawing industries to India. Let us now move on to markets. The ongoing war in Ukraine, hawkish global central banks, elevated crude oil prices, higher inflation and bond yields will be among the key factors driving performance of markets in this financial year. Our next report tells more about it.
Markets closed the 2021-22 financial year on a strong note, with frontline indices S&P BSE Sensex and Nifty 50 gaining 18% and 19% respectively. After markets posted a double-digit return for the second consecutive financial year, analysts expect the next 12 months to stay turbulent as higher inflation and rising interest rates cloud bourses. Market veteran Ambarish Palega too expects flat or negative market returns in FY23. Listen in.
FY23 could be a difficult year for businesses as well as markets. The disruption in supply chain caused by the sanctions which followed the Russia-Ukraine war, I think the pain will be felt for the next few quarters. There's a huge cost push inflation which most of the customer-facing businesses will find it difficult to pass through immediately, resulting in squeeze in margins. Again, FY23 could witness the change in the world order. We may look back at the year and say that this possibly was the start of the decline of US dollar. Overall, the global trade will not be the same from FY23. This will cause disruption initially, the brunt of which will be borne by the businesses as well as customers. Stock markets after 2 years of stupendous returns may be flat or possibly give negative returns as businesses adjust to the new normal.
Analysts believe inflationary pressures are expected to cast a shadow on India Inc. earnings this fiscal year despite reopening of economic activity. Corporate profitability remains at stake as companies hesitate to take price hikes. Given this, several brokerage firms have downgraded earnings outlook as companies expose themselves to increased margin pressure. Morgan Stanley has slashed earnings growth forecast by 8% for FY23. Meanwhile, Motilal Oswal too has cut earnings estimate for automakers due to fuel price hikes. Vinod Nair of Geojit Financial Services warns margin pressures and muted consumer sentiment to lower FY23 earnings roadmap. Listen in.
Currently, the market is expecting an earnings growth of around 15 to 18% during FY23. However, there are downgrade risks to the growth forecast due to high inflation. Inflation will generally help the corporates to report higher revenue growth, especially for companies associated to metals, mining, soft commodities and consumer goods, but it will impact the overall margin, profitability and demand of the economy. So there are downgrade risks. Some breather is that earnings forecast for the banking sector is very robust, which has a high mix of the total corporate financial numbers. This will help to maintain the overall trend. Also, any relief in the war, inflation and improvement in global supply chain is also expected in the future, which will also reduce this risk based on the developments.
Moreover, with global central banks increasing interest rates, India too will be walking a tightrope to control inflation and sustain durable growth. The Reserve Bank of India will hold 6 Monetary Policy Committee meetings in FY23 starting from April 6 to 8th. Though analysts expect the central bank to defer rate hikes for the latter part of FY23, investors will watch out RBI's commentary on inflation forecast. On the other hand, after a blockbuster FY22 for the primary markets, FY23 will see over 50 companies heading to bourses to raise funds, including the much-awaited LIC IPO. That said, a section of analysts expect equities to remain a favorable bet in FY23 as markets have priced in the bad news. Manish Jain, fund manager at Ambit Asset Management, believes strong rural demand and credit growth will steer markets forward. Listen in.
So I do believe that after the correction that we've seen in the last couple of months, the markets are now factoring in all the bad news, both from India as well as from a global market perspective. The Russia-Ukraine war situation, the commodity cycle, the rising interest rate scenario, as well as the inflationary pressures that we are going to anticipate are more or less now priced in. From a next year's perspective, I do believe equity markets look very, very well poised from a risk-reward situation perspective. We would expect the overall earnings to continue to grow at 12 to 13% pace for a market that is priced in at around 18 to 19 times. I think from a PEG perspective, that's very, very favorable. Plus, we would anticipate a strong revival in rural demand, continued strength in discretionary consumption, a strong pickup and a sustainable pickup in credit growth in the banking system, as well as a revival of the private sector capex. So overall, the right time to invest is now to make significant amount of money from the next couple of years perspective.
Against this backdrop, what trading strategy should investors adopt in FY23? A.K. Prabhakar of IDBI Capital shares his investing tips.
IT as a sector is very attractive. Even pharma, I think, is very attractive. They have not rallied also. Life insurance, as COVID is behind us, life insurance is one segment we need to concentrate. Defense manufacturing, if you get good companies there, these are the sectors you have to be. But other manufacturing sector, anything connected with crude, which is very volatile, I would avoid at this point of time. Even banks, I will be selectively bullish, not overall I will be bullish, because rising interest rate can have an impact on them.
तुम इतना डर गए? अब क्या किया?
शेयर्स में ट्रेडिंग।
तुम्हें 5 पैसा नहीं पता?
ओए, अब तो सबको पता है। 5 पैसा पर मिलते हैं रिसर्च टूल्स, पोर्टफोलियो एनालिटिक्स और इन्वेस्टमेंट आइडियाज भी। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है Investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Stock markets have the ability to pull up surprises, both pleasant and unpleasant ones, and even seasoned investors continue to stumble on the Lal Street. One such unpleasant surprise is called bear trap. Let us find out more about this concept.
In a bear market, prices usually fall over a period of time, giving traders an opportunity to make profit by taking short positions. However, if the market does not fall and rather turns around, the bears run to cover their shorts. In other words, bears are said to be trapped due to false signals. Let's delve a bit deeper into this market phenomenon and learn how one can avoid it. The highlighted area on the chart is a bear trap. The stock ended sharply lower, down 3% from the day's open after a gap up, indicating selling pressure at higher levels. In the following 3 trading sessions, the stock corrected almost 12%. This boosted the confidence of bears. After getting around 10% profit, the bears anticipated further fall at the counter. However, the bears got trapped as there was no follow-up selling. Simply put, a bear trap is a false indication of a negative reversal, which appears to be weak with corrective moves that lure short sellers, but then the prices see a steady recovery. A bear trap tends to have a significant impact on not just the trading portfolio, but also on the trader's mindset. To build steady profits while trading, consistency and ability to digest losses is a must. Every trade may not give the perfect turnaround as predicted. In cases where the trade seems to go wrong, exiting with minor loss should be considered as a viable option. But it is not easy to spot a bear trap at the onset. Here are a few hints that can help one avoid a bear trap. Validate reversals on weekly and monthly charts. Look for confirmations with gap downs, consistent fall in prices. Momentum oscillators like the RSI, MACD should be in overbought zone. Moving averages should show a slower rise. Avoid stocks hitting new highs. And avoid predicting reversals on intraday charts. Lastly, trading is also about developing strategies and trading principles. The most notable features of successful traders are patience and consistently following one's strategy. Instead of considering a larger gain from a stock, it is better to have a safe trade that can gradually broaden one's trading skills.
यार आइसक्रीम खाएं? नहीं यार, कुल्फी।
We Indians disagree on everything, but we agree. SBI is the banker to every Indian.
अरे SBI contactless debit card? I agree.
SBI is the banker to every Indian.
Analysts in the US markets have cautioned that the 11% surge in stocks in the last 2 weeks may well be a bear market trap. That's all for today. We will be back with more news and analysis on our next episode. Stay tuned and thank you for watching. If you liked this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.